The risk of liability for greenwashing in asset management continues to grow through the combination of increased investor demand for sustainable investment products, with evolving regulatory regimes and growing scrutiny from regulators, media, investors, advocacy groups, and employees. Priority number one in ESMA's Sustainable Finance Roadmap is tackling greenwashing and promoting transparency. Earlier this year, the European Supervisory Authorities for the financial sector published progress reports on greenwashing and outlined a high-level understanding of greenwashing as a practice where sustainability-related statements, declarations, actions, or communications do not clearly and fairly reflect the underlying sustainability profile of an entity, a financial product, or financial services. This practice may be misleading to consumers, investors, or other market participants. We would all recognize that deliberately providing information that is false or deceiving in relation to sustainability is classic greenwashing. But much of those reports focus on more passive or inadvertent examples. Those include vague or non-binding claims. I would usually advise clients against language in their offering documents that unduly limits their discretion where they might need it in certain markets. But given the potential inferences that could be taken from loose language in an ESG context, I think we may be moving away from that in these circumstances. This has also been an area of focus for the central bank in their review of ESG disclosures. Another example is highlighting positive aspects of an entity or product while failing to mention less ESG-friendly aspects, referred to as cherry picking. Using imagery or colours in marketing materials to imply sustainability was given as an example. This was also recently highlighted by the central bank as a practice that they do not approve of in circumstances where they had identified that the colours in graphs to the pre-contractual disclosure document had been changed from the template, including using green for non-taxonomy aligned investments. Finally, irrelevance, claiming an achievement that is actually a natural byproduct or common practice within a relevant market or investment universe, or which is actually required by law. Another interesting feature of the ESMA report was the emphasis it placed on reliance-based exposure, where an entity spreads a greenwashing claim made elsewhere in the sustainable investment value chain. For example, a claim made by an investee company, a data provider, an index provider, or your delegate. This emphasizes the need to scrutinize claims relied on for the purposes of your own disclosures. The central bank, as a major fund regulator, are enhancing their focus and were key contributors to the ESMA report. Questions in relation to the approach to mitigating greenwashing featured in the questionnaire they issued to sample fund managers in August as part of ESMA's CSA. They have begun communicating with industry about their findings and expectations through speeches earlier this year and a recent workshop with key industry stakeholders. To conclude, scrutiny is building, and regulation designed to combat greenwashing is going to continue and will likely draw upon the findings to date to map a path forward. For more information on this topic, I would encourage you to visit our ALG website, where we have a host of insights, videos, and articles on all things ESG, including disclosure and greenwashing.